In this video, I'm going to discuss the advantages and disadvantages of operating a partnership. So a partnership is really easy to form. You don't need to file any articles of incorporation like you would with a C Corp or an S Corp. You don't need to file articles of organization like you would with an LLC. You just start doing business. The downside is that you have unlimited legal liability. Okay. Now, there are things that can be done to prevent that. For example, instead of just having a regular partnership, you could set up a limited partnership where you have one or more persons who serves as the general partner, and then you have other people come in as limited partners. But the limited partners can't be involved in managing the business and so forth. But the limited partners would only be liable to the extent of their investment, whereas the general partnership could be liable beyond what they've invested in the partnership. And you have some of the large accounting firms have a limited liability partnership where basically the partners are only liable for their own personal actions, not the actions of other partners. Okay, so there's ways to kind of address this unlimited liability issue, but if we just have a regular general partnership, 2-3 partners, whatever, and it's not limited partners or anything like that, they're going to be subject to unlimited liability. So basically, if the partnership were sued, someone could come after their personal assets, not just the assets of the partnership. Now, a partnership is a flow-through entity, just like S Corp, sole proprietorships and stuff, so you're only going to have one layer of taxation. So that's an advantage just over C corporations. Remember, C corporations are subject to double taxation. Now, a disadvantage of a partnership, you're going to have self-employment tax, and it's going to be assessed on guaranteed payments made to the partners. Guaranteed payments you can kind of think is like a salary given to the partners, and then also the partner's share of the partnership profits, okay, will also be subject to FICA and Medicare tax. Now, the partnership, if you form a partnership, you can deduct the losses of the partnership. Okay, they will flow through. Remember, it's a flow-through entity, so the losses will flow through. If it's a $100,000 loss and it's 50-50, you can get $50,000 loss on your personal tax return on 1040 to offset your other income, okay, potentially. Now, it's difficult in some cases to add new investors. Sometimes it can be easy. Let me explain. If you, let's say you have 5 partners and you want to take on a 6th partner, right? You want to go on to this extra person and add them as a partner. All 5 existing partners have to agree. You can't just say, well, we have a majority or whatever. So if there's one person who says, I don't want to add that person as an investor, then it could be hard to bring on new investors. Okay, so everybody has to agree on any new investors. Now, there's no tax basically on property contributions. This is called Section 721. Okay, so if you contribute property, let's say you contribute land and it's got a basis of $100,000, but now the fair market value is $300,000, and you give that to the partnership, you'd say, well, I could have a $200,000 gain. No, per Section 721, when you contribute property in exchange for a partnership interest, it's tax deferred on that. Okay, and I'll make another video going through that in more detail. Okay, a downside of partnership, so when you have guaranteed payments, they basically reduce the amount of the QBI deduction. Okay, so the qualified business income deduction, and I'll make another video on that. I'm going to put together a whole series on partnerships. I'm just trying to give you an overview here. Now, one nice thing about a partnership, okay, and a reason some, like for example, low-income housing tax credit deals and stuff will be set up, if it's like structured as a partnership, is because when there's distribution of a partner, there's not necessarily going to be any tax. Okay, so if you distribute property to one of the partners or something like that, and with a corporation, when you have a corporation distribute property to one of the shareholders, there's typically going to be a gain, right? If it's appreciated property, and if it's like a lost property, the loss might be disallowed. Okay, so you generally don't have those issues with a partnership. It's easier than relative to a corporation. It's easier with a partnership to move property in and out of the partnership. Okay, now, any entity can be a partner. Now, this is an advantage over S Corps. Okay, with an S Corp, remember, you got a limit on, you can only have 100 shareholders, and a shareholder can't be a C Corp, for example. Well, a partnership, a partner is not just a person. A C corporation could be a partner. Okay, you could have a C corporate, you could have pretty much any entity can be a partner. So it's very flexible to who can be part of a partnership, whereas like with an S Corp, there's all kinds of restrictions. Now, another advantage relative to like S Corp and our entity types is you can increase, so when you think about like the partner's basis in their, so we're talking about like their partnership interest, okay? They can increase their basis basically by adding debt to the partnership. And you say, well, why would you want to do that? What is the advantage here? Well, you can only take losses up to, so if your basis is 0, you can't take any more losses. Okay, if the partnership has losses, you can't deduct them. So the partner, basically, if you say, well, I'm down to 0, where my basis is 0, you have the partnership take on more debt, and then basically your basis increasing, you could absorb more losses and get more tax deductions potentially. Okay, you can't do that, like for example with an S corporation, right? You can't increase your basis; it's not affected by liabilities and stuff of the entity. Now, one of the other really nice benefits of a partnership relative to any other type of business entity is the ability to make special allocations. When I say special allocations, I mean, for example, you could say, okay, we've got two partners and we've got this depreciation on this asset here. Okay, and we could, if we want, per the partnership agreement, we could allocate 100% of the depreciation deductions to this partner over here and 0% of the depreciation deductions over here. Now, as you might imagine, with special allocations, there's a chance for like abuse, where people like try and like shift like income to like the higher tax bracket person and stuff. So basically, any type of special allocation needs to be outlined in the partnership agreement, and it has to have substantial economic effect. I'll go into that in more detail. Partnership is the only type of entity that makes special allocations. An S corp, for example, can't do it. S corp, it has to be pro rata. Okay, so S corp can't make special allocations. I'll give it. Well, I guess if you have an LLC that is being taxed as a partnership, then it can make special allocations. So basically, you have to be taxed as a partnership in order to be able to make special allocations. So partnership it's a major advantage of partnerships.